Thank you so much, Anton. Great to be here again. It's a wonderful platform that you've created here in the startup ecosystem. My name is Hanim Dogan Jane. I'm originally from Turkey and I'm an exited tech founder. I had a software company which I was able to sell to an industry giant. Currently, especially in the last 7, 8 years, I have taken on the role as a angel investor, and I help startups and scale ups with growing their business. And my sweet spot is really female founders, as you all know, that only 2% of all the money in the world goes to female founders. So that really is my passion. Thank you.
Thank you very much, Anim. I think we said Robert, Alessandro, and last but not least, Jordan, please.
So my turn, and I love and I love your female founder focus. I am likewise focused on that as well. So Robert Hoken, Chicago accent you're hearing, but I've been in the UK 35 years. I'm residing in Glasgow. Corporate venture capital, a starting background. I've been in the trenches for over 30 years, creating, advising, investing, and bringing early stage technology to market. With Greenbackers Investment Capital, it's a corporate advisory program focused on clean tech. I've helped over 500 ventures, guided, raised many millions. I've probably looked at about 10,000 pitch decks in my lifetime. And outside of Greenbackers, I've founded 4 other ventures. I've had 4 exits, 1 turnaround, and I'm still excited about helping startups to scale, to access capital, and to make it happen in their respective fields. It's tech, really deep tech, any tech, in fact, that I'm interested in.
And my turn now. Thanks, everyone. It's Alessandro here, originally Italian, but I've been living in England for the past 30 years. My background is originally in investment banking, 13 years in the city in New York, and since 2008 have been an entrepreneur, and then turned investors with a strong focus on impact. So I, together with my co-founders, I'm involved with 4 businesses, but the main one that I represent today is Ethical Fin, founder and CEO of an FCA-regulated London-based financial advisory firm, where we support founders of both companies and impact funds with investor readiness and strategy, capital raising, and growth. We also arrange investment syndicates for our angel investment network, and I myself am an angel investor, and I really love connecting capital with purpose. So finding investment opportunities at the intersect of profitability and scalability with impact and sustainability at scale.
Hi there, guys. Thank you so much, Anton, for inviting me here. Pleasure to be here. I've got a background originally as a trader. I was a flow equity trader at Goldman. I then moved into wealth management for a multi-family office. Alongside that journey, I was also working for my own family's office. My father, Lord Fink, was a self-made, successful CEO of a hedge fund called Man Group before exiting in 2006. Since then, we've got a wide portfolio of companies, early stage, mostly UK, over a few different themes. We've had a prop tech, fintech, ed tech, ecotech, and the last few years, most of our focus has been on life sciences, of which my brother heads that up. I myself oversee the equity strategies and some of the fintech investments. As well as that, we are quite active, and I'm doing a few days a week helping out essentially an AI analyst tool, which I'm happy to speak about down the line, but doing that part-time as well, helping to scale that business because it's quite a new venture. Really happy to be here. Thanks so much.
Wow, this is amazing. What a team. Thank you very much for joining us today. We really appreciate you all. Now, we've had about 290,000 people that have tuned in the last just over 4.5 years. And obviously, none of that would have happened without people like Hanem, Robert, Alessandro, and Jordan. So if you panelists would like to drop your LinkedIn URLs in the chat, and maybe just a couple of words about what your focus is mainly when it comes to startups, please feel free to do so. The least we can do in return for your kind help is follow you on LinkedIn, I guess. So please feel free to do that. And as you do that, perhaps we can start with some do's and don'ts when it comes to early stage fundraising. I'm sure you've seen some horrible stuff, but also some brilliant stuff that founders do out there. So if we can try and keep it to about a minute each, one do and one don't, and let's not use the same logic for both, please. So perhaps we can start with Alessandro, Robert, Hanem, and last but not least, Jordan, please.
All right. Yeah, so I'll pick the top two that come to mind. So the first do is definitely do your homework. What I mean by that is that founders sometimes overlook very important elements of defining their fundraising strategy, and especially being prepared for the process and the meetings with investors. So do your homework, in my opinion, means being prepared in terms of having your material very well structured and documented in terms of pitch deck, business plans, and the data room, etc., as well as your research around your market, your competition, and the investors also you reach out to. In terms of don'ts, my favorite one is don't second guess investors. And what I mean by that is don't assume in your mind what they're going to think or what they're going to ask, and or what's their logic for investing in your business. It's very important to ask questions that really you have top of mind, to make sure that you really understand where the investor is coming from, what their motivation is. And what I like to really see more and more is a much more level field between founders and investors. That has been very difficult recently because of the challenges in raising capital. And so founders sometimes are desperate to get money, and they accept money from anyone. But it's extremely important to actually select the right investors for you. And I'll stop there for the 1 minute you gave me, Anton. Thank you.
Hi, Anton. So if I start with the do's, I think me included at the time, founders underestimate the time that is needed for fundraising. I mean, it can be just like a full-time job, and especially if you're a sole founder, it's really overwhelming. But I just want to emphasize the do is allocate time for fundraising. It's not something you can just do on the side, especially if you're an early stage founder on doing everything at the same time. So make sure that you have allocated proper time in your schedule for fundraising. And secondly, the don't is don't start when you desperately need it. And obviously, this sounds easier than it is. I think it's really important to understand what runway you have. I've founders come to me when they have like 1 or 2 months left of funding their own business. So, ideally, you want to raise where you are in a space where you don't really urgently need it. So your runway could be 12, 18 months or even longer. So thank you.
Well, everybody's gone and pipped me at the post for the dues, but I'll give you another one. Equity is expensive, and so what I would encourage you to do is question yourself: do you really need it? There's a lot of non-dilutive options out in the marketplace, not just grants, but different flavors of debt. Not all of them have personal guarantees, so it's nothing to be afraid of. And debt, even at the interest rates that we're talking about today, is cheaper than equity. So take that into consideration. And as far as don'ts, maybe this is on the back of Alessandro's comment about do your homework. Don't just spray and pray. And what I mean by that is quite often I get outreach from founders who have seen investment or capital or fund on my handle and just assumed that I would invest in their sector without knowing anything about me. Or the other 50 to 100 funds that they have learned about in the marketplace. So I agree with Alessandro. Do your homework, but know who you're speaking to as far as a fund is concerned. If you are looking for equity, and try to personalize it as well. You understand if they've been investing in your sector, who they've invested in, and maybe that's a potential opener for you. I'll stop there.
Jordan, it's
Oh,
your
sorry, I
turn.
wasn't sure if it was down to me. Brilliant. Thanks, guys. I was going to definitely say identify the different tools at your disposal if they're relevant to your business. You know, it might even be invoice financing or any other approach. You know, definitely do look at the big picture and whether to consider equity. In terms of my do's and don'ts, I'd say my do is well, be enthusiastic, optimistic, but not deluded. You know, I think you should always have a base in reality and, you know, understand, be human. These people will understand that you're a startup and that you're going to face hurdles and bottlenecks, and identify what they are, but don't just pretend like they don't exist, you know. So I think there's certainly a balancing act to be struck. And then don't, it obviously depends on very idiosyncratic to the business. But you can't get too proud over valuations, especially as my other hosts have said, when you're up against the wall or when you're not negotiating from a position of strength. You know, pride is a really powerful emotion, and sometimes it's better to have a smaller slice of something than a bigger slice of nothing. And you'd be surprised how many people might need to be reminded of that at times. But yeah, that would be it for my top ones.
That is amazing. Thank you very much to all four of you. Right, we are going to get going, but just before, for those of you that have just joined us, this is Startup Fundraising Q&A 163. It's our last fundraising session for this year, and we're here to help you with whatever questions you may have in terms of your fundraising journey. There literally are no wrong questions, and there's no need to be shy because it's a learning curve for us all. In terms of what you can ask, it could literally be anything from investor outreach to perhaps valuations, exits, crowdfunding, due diligence, pitch decks, how much to ask for, when's the right time, who do you approach, how do you choose whether you need a VC, CVC, an angel, grants, and all that jazz. If you're on the live streams, unfortunately, we can't monitor your questions live there. So best thing to do is join us here on Microsoft Teams. It's audio only, which means all you have to do is go to our website, startuptoscaleup.club. So again, it's startuptoscaleup.club. You scroll down a little bit, you'll find today's session, which is Startup Fundraising Q&A 163. Click join, quick registration on Luma. That gets you to a site. Well, you'll see the link for the Microsoft Teams call, and then you can tune in. Again, being audio only means you can join us from anywhere via any platform or device. Once here, simply drop your question in the chat. We'll give you the mic, you introduce yourself, and then fire away with your questions. Now, if your questions are not on fundraising, bear in mind that you'll need to save them for some other time. Because we're going to take some time off during the Christmas and New Year's break, what you might want to do instead is join our WhatsApp community and ask other founders and investors and our operators and mentors and panelists there as well. You'll see the WhatsApp icon at the top and bottom of our website there. If you click on that, you'll be able to join these groups. But in general, just as a reminder, we run 6 regular events: Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of each month is UK Startup Law, and third Friday of each month it's UK Startup Finances, which we'll do tomorrow. And that will be our very last Q&A for this year. Now, without further ado, we'll read a question that was sent in to us. This is a sustainable packaging solution for food industry near Leeds. They're planning to raise a Series A in Q2 next year, that is. Plan to focus on impact investors. Question: as a sustainable packaging startup preparing for Series A, we want our data room to meet both financial and impact-driven investor expectations. Besides standard financial metrics, what impact data should we include to demonstrate our product's environmental impact, especially for impact investors? Our life cycle analysis or partnerships with certifying bodies like B Corp expected in Series A data rooms for sustainability-driven investment? Oh dear, what a question. Also, what is your best practical tip for outreach? That's interesting. Well, maybe we can start with Robert, and then Alessandro, then Hanem, and last but not least, once more, Jordan.
Okay, well, this is an area that I know. Alessandra does as well. I think there's some essentials and some non-essentials here. I'm going to take the first question and let others deal with the outreach question. I think as far as essentials, I mean qualified environmental metrics. So I'll give you some examples: carbon footprint reduction versus conventional packaging. Tons of CO2 saved per unit. Material circularity rates, so recycled content percentage, recyclability rate, actual recycling rates of measurable, waste diversion metrics, so how many tons of virgin plastic and other materials displaced, water and energy savings, end-of-life date, just to name a few, and then supply chain transparency. So how traceable is the documentation for raw materials, supplier environmental and social standards, geographic sourcing. As far as LCAs and certifications, it's not universally expected, I think, at Series A, but it's valuable for impact-focused routes. So if you have one, get a commission from a reputable third party. Compare your product against 2 to 3 conventional alternatives. Include a cradle-to-grave or cradle-to-cradle assessment or analysis. B Corp certification you asked about, again, not typically expected at Series A. For your UK or European deals, the process can take up to a year. It can cost anywhere from $1,000 to $50,000, depending on the company size. However, you can show that you're B Corp assessment ready. So there's a free assessment, including a score in the data room. So you could mention that certification in your pitch. I mean, ultimately, what impact investors want is proof, impact for pound investment, and impact KPIs in a monthly reporting basis. I think I'll go quiet now. I hope that's helpful.
Was I the next one? I think I assumed, yeah, correct, Anton?
Yes, you are, Hanem. Then it's Alessandro,
Okay.
and then Jordan.
All right, I'll take the question of best practical tip for outreach. I think in general, it doesn't really matter what industry or what stage. For me, one of the key elements is to have an exit strategy and to highlight that during the fundraising. So what's in it for investors? I think founders really prepare very well on their MVP, on their scalability and product and go-to-market strategies. But still, I do see a lot of pitch decks where there's hardly any mention about what is the exit strategy and what's the return on investment for investors. I think that's really, really key. And I would also say, especially in Series A, the outreach should be really targeted instead of just cold calling hundreds of not very targeted investors. So those two are really important.
Yeah, excellent points actually already mentioned. So I'll try to think hard about what to add. I mean, in terms of the impact measurements, I mean, of course, this is an area we are very focused on. But Robert, you covered really well in your answer. A lot of the topics that I had in mind as well. I mean, of course, a lot depends on the industry that the startup is focused on, and investors will have their own requirements. But one of the key elements is really carbon capture or carbon reduction. So measuring your carbon emissions and the reduction of those is very important. But also understanding what really drives the purpose of the organization in terms of impact, and as an organization coming up with what you think are the most relevant KPIs to monitor. So it could be, I don't know, people affected or employment created. It's really thinking hard around the externalities that the business creates. And it can be the positive change, but also displacement of negative externalities that your industry is typically associated with. So if we had more details, maybe we could go into more into more examples. But I hope it's not too sort of generic. And normally, in the conversation with investors, you will actually explain the logic, as a founder and as a management team, of the impact KPIs that you've chosen, and through that conversation and dynamics, you can agree on any tweaks to the KPIs that you're going to monitor going forward. Anton, you want me to add also on the outreach, or should we leave that for the other speakers?
Yeah, let's leave that for Jordan. And the reason as some of you might have noticed, I tend to leave our new ones last for the first couple of questions, just to give them time to see how bad the rest of us are. So, Jordan, take it away.
Well, I was going to say thank God for that, because I don't have any value to add answering the first one anyway. So no, I mean, good advice from the others. Yeah. In terms of outreach, look, I think there's a lot of different ways to go about it. I think generally, I would say start early, build relationships as early as you can. You've also got to always think 1 or 2 degrees beyond the person you're meeting. Is it worth spending time on this person? Maybe. If they then have access to more people, is it worth putting in, the energy? But equally, you've got to be friendly. You've got to be open to exploring all avenues. In terms of impact in particular, I think there's a fairly well-trodden path now. It's not as much of a new topic. So you can very much, do market research, see who the other success stories have gone to, who are the VCs, who are the family offices, how did they meet them, where are they getting their press attention. Maybe I can get press attention there if I'm doing the right things. And so I think you should be open to exploring all sorts of partnerships. And what's obviously quite nice is that it's usually a nice story to tell. I mean, in this case, it sounds really great. So, positive press, speaking to the right people, building relationships early. That would be it from me, really.
Amazing. Thank you very much to all of you. We're now going to put in another question. But first, I'm going to read and give Duncan the mic. So Duncan has asked a question. Wait, let me turn on the mic for you, Duncan. Bear with me. Where is Duncan? Allow mic. Right, so by the time Duncan is audible, team, please have a look at the question that Duncan's put in the chat. But basically, it's a pension pay and he's about to start launching a seed funding round. Are you audible now, Duncan?
Yeah, I am. Thank you. Yep.
Yes, you are. You're very welcome. Thank you for joining us. Quick introduction, please, Duncan, and where you are, and then fire away with your question. And then maybe we can have Hanem, Jordan, Robert, and Alessandro. Take it away, Duncan.
Yeah. Well, firstly, nice to meet you, everyone. So yeah, pension pay directly staples prepaid debit cards and bank accounts to the pension pot, so it disintermediates the typical retail banks. And the reason for that is that today it takes people 6 to 8 weeks to withdraw their pension. That causes them to over withdraw, and sometimes, well, actually 60% of cases, to fully encash their pensions and withdraw it, which is a really bad outcome for pension providers, because obviously those assets permanently walk off the book. So we've secured our first and second customers and sort of have, close to £1 million in recurring revenue. And we're about to go for our first, well, I guess it's a late stage seed. One of the challenges that I'm potentially worried about is that the sales cycle, given the size of these enterprises, and they're naturally conservative, is that it's a longer sales cycle, and that somewhat, to me, sits at odds with the nature of VC capital because of the velocity. But that notwithstanding, these are large contracts where landing a single contract is transformative. So I guess just some advice on how you would introduce that, talk around it, and give people comfort would be really helpful. Thanks.
That is amazing. Thank you very much for that, Duncan. I wish we had some of the institutional VCs we sometimes have on this panel, but I'm sure the panel here would be more than happy to give kind of their thoughts on this. So if we can start in that order, then please, Hanem, Jordan, Robert, and then Alessandro. Let's try and keep it about a minute each if we can.
Yes, thank you. Actually, I can speak from a founder perspective. Now I'm putting my founder's hat on instead of the investor, because the first business that I exited actually was a software company in ERP, Enterprise Resource Planning. It was a competitor at the time of SAP, and people who are maybe in the software industry will understand that. However, the sales cycles were as long as well, 18 to 24 months. Duncan, similar to your case, and the sales orders were, an average order was 1.5 million. So I think really great question that you answer here. How would you handle the fundraising and who to target? I think, as I can see here, you secured 1.2 in pre-seed funding from a single family offices. So there's two things I think that'd be interesting. Definitely family offices, because normally their return on investment and the exit strategy is longer term than on average for VCs. And in the VC space, institutional VCs, but also look at the sector that they're investing in. That's really, really going to be critical. Thank you.
Hi there.
Thanks, Hanem. Jordan.
Oh, perfect. So obviously, congrats on the story and all the best with it, Duncan. Sounds like a really interesting product and fills a nice liquidity gap for those customers. I think in terms of presenting it to VCs and to family offices, potentially in terms of where you're at with the various contracts, I think you can do a few things to sort of paint a picture. In terms of, you can always try and break it down into how far along you are with whichever contacts and what the potential scope of that is, and you can try and attach some estimated values to that. Naturally, they should be defendable numbers and conservative, and that way you can paint a better picture. I would also try and it's a bit awkward. It's a bit like asking for feedback while on a date in terms of getting details on it. But even if there aren't heads of terms ironed out, the companies you're working with will know you're a startup, and so it's not weird or unusual to ask for even letters of intent and things like that, just to at least then put a bit of clarity as to when you're presenting it. These aren't just I've met them for a coffee. That there is genuine intention there. Aside from that, family offices are good. They're probably more likely to buy into the vision and press you less on the pressure to get that revenue up. But it's also about finding the right VC that will understand. I think is if it's a very generalist VC, they might have less patience for something like this. But if there is someone who has done this sort of investment before, there's more likely to be read across and an easier story to sell.
Thank you very much, Jordan. Robert?
Okay, Duncan, hey, I think you have a framing opportunity here. So, and I get where you're coming from as far as time to close deals. I think your framing is, we're not building a 1 million ARR company with 100 customers. We're building a 10 million ARR company with 10 customers, and we've already got 2 or 3 in the pipeline. So what investors are probably fearing, and how you counter it, is you're going to run out of money before first revenue. So your counter is show pipeline coverage. We've got X million in qualified pipeline, stage 3, representing X amount of runway coverage. Prove cycle predictability. So our pre-seed customer took X months from first meeting to signature. We now have 3 to 5 prospects per month that making Q whatever 2026 signature is highly probable. De-risk with pilot revenue. We're generating X amount of revenue in pilots, proof of concept fees during the sales process, offsetting X amount of sales cost. And another fear is, it's a long sales cycle, the founder can't execute. So map your conversion funnel, Duncan. 7 qualified prospects, 3 at commercial terms, 2 in procurement. We shorten the sales cycle from 24 to 18 months. Blah, blah, blah. Show board level champion strategy. So each prospect has a C-suite sponsor. Here's our governance engagement models that keeps the deals moving. So and you could create a slide that kind of wins this argument. So in the left column, you've got how many months to 1 million ARR, how many customers, what's the annual churn, what's the sales cycle, what's the what's the acquisition cost value, etc. And then in the right hand column, how much how long does it take to get to 2 million plus ARR, with the customers that you think will come in? What's your churn potential? So do you have a structural lock-in? What's your sales cycle, etc. So the bottom line is, capital efficiency, higher terminal revenue per customer, infrastructure grade retention. And don't say our sales cycles are long, but what you do say is we're building a critical national retirement infrastructure. Our customers are pension funds. They move deliberately because they're regulated entities, which is exactly why revenue is infrastructure grade recurring. Hope that helps.
Thank you very much. And last but not least, Alessandro, please.
Yeah, they were all excellent points from the other speakers. So what I would add is, we come across oftentimes technologies or solutions that have this, similar issue. And so what I find extremely compelling is Duncan, really articulating extremely clearly what are the pain points that you're trying to solve, whether that's coming from research papers or whether that's coming from industry-wide analysis, or whether that's coming from your understanding of the industry, with the insights that you have, or even better, from explicit testimonials from your clients, formulating very, very clearly the pain points that will help you understand the market size. and it can then lead to very clearly calculating, or let's say expressing and highlighting how you're solving those pain points. So making it as clear and compelling and concrete as possible. I highly recommend that you analyze both from a quantitative point of view. So you're in terms of the timeline that saving, how quickly your solution will address the pension timelines. Also from a qualitative point of view in terms of service, customer service. So how you plan to ease those pain points, I think is going to be very important. And if you can have testimonials from your target clients about the way they perceive your solution and why they would use it, I think that will give confidence to investors that you've done your analysis and you understand the market dynamics very well, and that prospective customers and clients do feel the pain and do appreciate the solution that you're coming up with, both from a economical point of view, but also from a qualitative point of view. And so having that sort of understanding and clearly spelled out, I think is very powerful. And last but not least, I would also be extremely clear about your go-to-market strategy. So the investors are betting on you, on your ability to come up, of course, with the business plan, but also with the with the ability to execute on that. And so having a very clear go-to-market strategy that is connected to what Rob was describing about the pipeline, I think that's very, very important, so that you can show your prospective pipeline, but in line with your go-to-market strategy, either direct or through intermediaries, your existing conversations, your target class customers, targeting, of course, the largest ones, but also figuring out whether the maybe smaller institutional will be quicker in their decision-making process. So having that clarity of go-to-market strategy would be very, very, very powerful in my mind.
Thank you very much, Steve. And Duncan, if I may add a couple of quick things. All this was absolutely golden advice in my view. What I would do, have you got a board of advisors, not the actual board itself, but advisory that aren't involved in governance? Have you got one?
Well, firstly, thanks very much to everyone for those responses, really helpful and insightful. But to answer the question directly, yes, we do. We have a board of advisors as well.
How big is it?
It's only a board of 2 right now. I'm conscious of overloading it
okay.
at this stage. But
I hear you. And so they're not part of governance. They're simply just normal advisors, right?
Correct. Yeah.
Okay. And what was their background, if I may ask?
Well, there's one that's a well-recognized financier, and the other is more of a pensions industry luminary. You'll find there's not a lot of pen tech, if you like, for this exact reason. There's quite a long sales cycle.
I hear. Okay. Here's what I would do. I would try and get a board that is up to around 10 people, and I would staff it with 3 kinds of people. One, people that were in very high, or still are in very high positions. I'm talking chairman, that kind of stuff, from potential customers of yours. The other, people that have exited similar businesses to yours. And last but not least, maybe 1 or 2 who are and have had substantial experience in either grant assessment or working for grant organizations that dealt with similar applications to yours. And I would start with a 0.1% equity, if you can, but absolute maximum 0.5%, unless, I don't know, it's Richard Branson, then maybe you can go up to 1. But otherwise, you've got to try and keep it to 0.1% and not ask of them more than, let's say, half a day per month in terms of potential help. Once you have that in place, then I would do 3 things. Number 1, I would try and get some grants from the likes of Innovate UK and Horizons or some other EU that invest in the UK for two reasons. One, because it's free equity money. And two, most importantly, all of these, they've got their own networks of investors. These investors will like the idea that these entities have given you a grant and in a way they've de-risked their due diligence. And therefore, you are then able to go into that pool and say, look, I reached out to you because I saw you on that list. We've just gotten whatever grant, and I'd love to have a chat with you. Once you've done those things, it will also help you keep the lights on until, whatever sales cycle is finished. And when it comes to how you start this conversation, how you position this, I would start from a position of strength, Duncan, and say, unlike other businesses that need to try and spend a lot of money to acquire a lot of customers for not a lot of profit, ours is very different. It's stable. We spend a long time building very strong relationships with these customers so that once they're in, we're going to make a ton of money from them. And through these advisors that you have, perhaps they can help you open some doors and get, as somebody here mentioned, some kind of letters of intent or some kind of in there. So go through this unashamed and with a position of strength approach, i.e. we are the kind of company that builds strong relationships and therefore longer sort of account management, whatever you want to call it, in terms of those profits. I hope that helps, Duncan.
Very helpful. Thanks very much, all.
Brilliant. Best of luck, and please do feel free to join us again, either tomorrow for finance or in the new year for the other sessions, but we'd love to hear on your progress. We now have 11 minutes to go, so perhaps we can go through at least one more question. I'll read this out loud quickly, but the panelists can go through it in the chat and refer to it if you like. So this is a blockchain for supply chain transparency. They're in Birmingham seed stage. The current situation basically is that blockchain solution for supply chains. Investors are concerned about market volatility and lack of IPO potential. So the question they have is, our blockchain supply chains transparency platform is seeking seed funding, but investors are concerned about decent exits, mostly the lack of IPO options. How can we structure our business model to offer an attractive acquisition path? Or are there UK-specific secondary markets we could consider as an alternative? Should we pursue partnerships with logistics giants as a way to establish a clear exit roadmap? I like the logistics giants as well, as long as you make sure that you can get investment and do business with whoever you want. London Stock Exchange has launched PISIS, which is for startups to pretty much float. I'm not sure if that includes blockchain, but I would look into the what's it called? They have some sandboxes, the financial regulator, FCA, so maybe might be worth looking into that. But for this, let's hear it from, let's go to Alessandro, then okay, then Jordan, then Hannum, and last but not least, Robert, please. 1 minute each, please.
Yeah, so I think, as you said, Anton, the corporate route, where you actually have already conversation with potential users of the platform, which can be also exit partners, that could be a very good way of doing it. Secondly, I wouldn't worry too much today about the current IPO market conditions, because hopefully that will change over time. And they are a seed round, so it would take a few years before they should worry about exits. But in terms of alternative secondary options, they can also consider a platform called JP Jenkins that provides secondary liquidity for companies without going through a full listing. And I know that the London Stock Exchange is also working on a alternative listing platform that allows for unlisted companies to trade their shares on the exchange with lighter touch requirements for the businesses.
Thank you. Yeah, that's the one they call prices. I think we said Jordan, then Hanem, then Robert, didn't we?
Yeah, I too was actually going to mention JP Jenkins. I don't know what the liquidity is like in terms of on the investment side, but if that's your goal to sort of show that there's interest, that's definitely a path to build up a track record. Similarly, I wouldn't get too bogged down in the IPO landscape. I think A, it is getting better, but B, it's not the be all and end all. If you've got a healthy, profitable, or hyperscaling business, I think that's more the story that you need to sell. I think the exit path is part of it at this stage, but at seed, it's not going to be a huge topic of conversation, at least not when I've been investing in seed companies anyway. We would chat about the path to exit, but it's not going to be my primary reason for investing. But maybe that's different for VCs. I would definitely consider industry exits as well. And again, it doesn't necessarily have to be a direct customer of yours. It could be a related upstream or downstream or adjacent business. So, one where there might still be a synergy or complementary service or overlap. So definitely worth exploring customers, but also to go a bit beyond that. Yeah.
Thank you, Hanem.
Yes, I would recommend to take and separate the business model from the acquisition path. Your business model is something you should be focusing on right now, on how to grow your business and go to market and have a proof of concept. And when it comes to an exit strategy, I think having an industry leader definitely on the horizon. I don't know exact numbers, but I know in 2025 secondary markets was up, and so that's been a growing market for people looking into exits, and industry leader exits is also very common. So I wouldn't worry so much about the IPO.
I think we said Robert. And by the way, sorry to interrupt, Robert. Have we got time for one quick question after this? If yes, please let me know in the chat. If not, then let me know too. Yes, Robert.
I'm going to have to love you and leave you on the top of the hour, but let me address the question. If investors are worried about exits at seed stage, that's usually code for we're not convinced that this is a big enough business. So exit strategy conversions at seed are often a polite way of signaling fundamental business model concerns them. So let's kind of be direct on what's actually happening here. So investors are going to see, blockchain supply chain is crowded, hype fatigue category. Most blockchain supply chain plays from 2017 to 2021 failed to gain any traction at all. Enterprise adoption has been slower than predicted. Blockchain may be a solution looking for a problem rather than essential infrastructure. So the questions that you need to answer is: would your customers pay the same price if this was a centralized database with an API integration instead of blockchain? Is blockchain generally needed for your value proposition, or is it just your tech stack choice? So do you have revenue traction proving that enterprises will pay for supply chain transparency? Because if you're building a valuable business, solving a real supply chain problem with strong revenue growth, customer retention, investors won't give a damn about blockchain or worry about exits. They'll see a B2B SaaS infrastructure play with clear acquisition interests from logistics or supply chain software giants, maybe ERP. So you asked about IPO path. I think you should forget it myself. It's not happening for B2B supply chain infrastructure at your scale. Last UK supply chain tech IPO, I think you'd have to go back years and reach hard to find one. Even in the US, IPOs are rare. I think M&A is your realistic exit. Your natural acquirers are supply chain software, logistics providers, ERP platforms, maybe some private equity roll-ups in logistical tech. Um, I don't think the UK secondary markets are actually relevant. AIM is for growth stage, doing 5 million plus revenue. There's really no secondary market for seed stage and blockchain companies, in my opinion. I don't think that's a thing, but I'm happy to be disproven on this. So I think you stop leading with blockchain, you lead with the problem. I think better framing is we're a supply chain verification infrastructure play that enables cost reduction, fraud prevention, however you want to position it. I think strategic M&A is your natural path to exit once you get to one, but you're at seed stage, guys. I think that's a clever way of phrasing from from the investors that you're speaking with, as far as concerning about your ability to scale the business.
Thank you very much, Steve. We've got 2 minutes to go, so we're going to wrap it up since you need to go. I'd love to get some quick parting words, though. Hanem first, then Robert, then Alessandro, and last but not least, Jordan. Take it away.
Sorry, who goes first?
Lady of the house, Hanem, if you can, please. Are you still here with us, Hanem? Probably not. Okay, in that case, Robert, Alessandro, and then Jordan, please.
Right, guys, it is tough out there, and you've got to be hyper focused on your program. To be good is not good enough. To be better is not good enough. Good, better, best. Get to be the best of the best. I think there's been a lot of great guidance here today. Be specific in your outreach. Be ready for due diligence. Consider the funds that you're reaching out to. Research the hell out of them, and go forward with gusto, guys. 2026 is the year to make it happen. Make it happen. I wish you all the best, and if I can help in any way, my connection points are in the chat area. Good luck.
Thank you for your support so far, Robert. Have a great Christmas and New Year's if you celebrate them. Otherwise, have a great end of year and brilliant start to 2026. Alessandro?
Yeah, on my side, I just wish everyone a great and relaxing Christmas holidays. Yeah, whatever you celebrate. I think it's a beautiful opportunity to reflect on the previous year, to start the new year with new energy, new motivation, good intentions, getting the support from family and friends, surrounded by love, making sure that you take care of yourself as much as you take care of your business. So thank you, everyone.
Grazie mille, signor Melle, and thank you for your support as well so far. Have a great Christmas and a great New Year too. Jordan?
Guys, just obviously wishing you all the best of luck in terms of parting words or advice. As I said, be hungry, be optimistic, but be grounded in reality. Don't be proud, and that's both on the fundraising numbers, but also in asking for help. Whether it's friends, or you might not have a rich dad, but you might have friends or family friends who know people who do. So don't be proud. It's not you're not on an island, and so definitely get help where you find it. You've got to be proactive and make your own luck. So good luck out there.
Thank you very much, Jordan. A belated happy Hanukkah, and hope you have a great New Year's too. And thank you for actually kind of saving the day and joining us last minute. Really appreciate that. Rightio, a couple of quick things from me before my parting words. Today was our last startup fundraising Q&A this year. Tomorrow it's startup finances, and that will be our very last Q&A for 2025. And you may want to join us in January. Our first session will be on the 12th of January when we resume, and it will be a Monday, so we'll resume with talent. We also have between now and then well, actually, we always have them, but if you want to connect between now and then, we've got some amazing WhatsApp groups. We've got groups that you can connect with other founders, investors, operators, of course, our panelists/mentors. I've put a link in the chat here for the group that we have specifically for fundraising. Please feel free to join that. On the other hand, just a reminder, we run 6 regular events: Mondays talent, Tuesdays product and tech, Wednesdays growth, Thursdays fundraising, second Friday of each month it's UK startup law, and third Friday of each month it's UK startup finances. They're all from 12 to 1 p.m. UK time. You can RSVP to any future one via our site, startuptoscaleup.club. Again, the site is startuptoscaleup.club. And as far as my parting words are concerned, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime and be kind to yourself and everyone else for that matter too. Otherwise, see you tomorrow for Startup Finance Q&A for UK startups at 12 to 1 p.m. Thank you and God bless.